Welcome back to the deep dive. Today we're undertaking a really critical mission. We're going to plunge right in to the very specific, and I think for a lot of people, pretty confusing state of the Bitcoin market. Specifically, as we're turning the corner here into early January 2026. This isn't just a general overview. We are putting a laser-focused spotlight on this structural phenomenon that, well, all the analysts are starting to define as an inevitable supply shock.
Yeah, and the timing for this is perfect. We've synthesized just a mountain of data, market reports, really detailed on-chain charts, behavioral signals, and they all paint a very, I'd say, an extremely constructive picture. It's an accumulation phase outlook.
Right.
And I think if you're just looking at the price action right now, I can feel like a really frustrating, boring sideways grind. But the sources we have, they tell a story of immense underlying structural health.
That structural health is exactly what we need to eliminate for you. We've all watched Bitcoin consolidate just stubbornly between, what, $88,000, $90,500
Right.
in that channel.
It's been happening ever since that high volatility distribution after the massive October 2025 peak of 126,000. It just feels stuck.
It does.
So the big mission for this deep dive is to answer two key questions. First, how is the market managing to consolidate at such a high price floor? And second, why do the experts we're looking at believe a massive supply-driven breakout isn't just, likely, but actually mathematically inevitable?
Well, when you look at the daily charts, you see the short-term hurdles, you see the overhead resistance, and we're definitely going to get into that. But fundamentally, the sources reveal a structural setup that is, it's genuinely rare. The central theme that really defines this moment is what we're calling the structural supply vacuum.
A supply vacuum.
Yeah. Imagine a bathtub where the drain's been left open and the faucet is just barely trickling.
Yeah.
The liquid inventory, and by that I mean the coins available for immediate purchase, they're simply evaporating. They're moving into long-term illiquid storage.
And that structural reality, it just cannot persist indefinitely when it's met with even modest, steady demand. The pressure has to release somewhere.
Okay, let's unpack this vacuum. I want to start with the most visceral piece of evidence, the metric that really defines this scarcity we're talking about. The Bitcoin exchange balance. This figure is, well, it's the direct measure of the supply that is actually accessible for immediate trade. And the data point is genuinely staggering.
It is. It's the foundation of the entire thesis. The reports we've analyzed confirm that centralized exchange reserves have just plummeted to approximately 2.49 million BTC.
2.49 million.
That's not just a low number. It's the core metric signaling that the system is critically starved of liquid capital.
2.49 million Bitcoin. For anyone listening, that figure, it still sounds huge, right? But in the context of the total circulating supply, which is what, approaching 20 million now?
Yeah, getting close.
It sounds like pocket change. So what is the historical weight of this number? Why is it setting up what you're calling a supply shock?
Well, this 2.49 million BTC figure, it represents a multi-year low. And to really grasp the severity of this illiquidity, the sources state we haven't seen reserves this thin since, the depths of the 2018 bear market.
Wow, okay.
But back then, it was low because demand was completely non-existent. Nobody wanted it. Today, it's low despite the price consolidating near all-time highs, and that means demand is steady and it's actively absorbing every last bit of supply.
So we're talking about two completely different psychological environments.
Totally different.
Leading to the exact same level of acute scarcity.
Yeah.
So what's the current implication in terms of, percentages?
Well, if you calculate the percentage of circulating supply against this reserve number, we find that less than 13% of the entire circulating Bitcoin supply is currently available for quick trade on centralized exchanges.
Less than 13%.
Just think about that for a moment. It means 87% of the coins are locked away. They're either in deep, long-term cold storage wallets or increasingly in institutional custody. The supply available to meet instantaneous demand is now ridiculously thin.
And this acute illiquidity, this is precisely where the mechanism of the supply shock really kicks in. We hear that term thrown around all the time, but what does it actually mean in this very specific, constrained context?
It describes a very specific, nonlinear market dynamic. So a supply shock occurs when that liquid inventory evaporates because of persistent, steady demand. Imagine the order books on an exchange, right? The lists of bids from buyers and asks from sellers.
Okay.
When only 2.49 million BTC are sitting on those exchanges, the ask side, the willingness to sell it, becomes incredibly shallow. The market makers who provide liquidity, they have a diminishing pool to even draw from.
Meaning what? What happens then?
Meaning that if a major buyer, let's say a mid-sized institution, comes in with an order for just a few thousand Bitcoin, they literally cannot fill that order at the current price of $90,000 without moving the price, and moving it significantly.
Right, there's just not enough for sale at that price.
Exactly. Historically, there would have been ample reserves to absorb that kind of demand. But now, because the order books are so shallow, any sudden burst of buy-side pressure immediately overwhelms the remaining supply. It forces the price to jump, vertically, until new sellers are tempted to enter the market at much higher prices.
And the result is rapid, nonlinear price appreciation.
That's the shock.
That explains why the breakout will be so violent when it happens. But we need to be clear about where this inventory is going. It's not just disappearing into thin air, it's migrating.
Right, and the data details a massive sustained migration. Bitcoin is leaving centralized exchanges, and it's heading to two primary types of highly illiquid destinations. First, individual cold storage.
The hodlers.
The hodlers, exactly. Investors with conviction who remove their coins, sometimes for years at a time. And second, and this is increasingly critical, institutional custody vehicles, specifically the spot ETFs.
Let's double-click on the ETFs for a second, because this is a relatively new factor in this cycle compared to, say, 2018. How do these institutional products drive the supply vacuum differently from just an individual putting coins in cold storage?
It's a great question because individual cold storage is illiquid, but, in theory, those coins could be reactivated. If the price skyrockets, an individual might decide to sell. Institutional absorption through ETFs is functionally different. When an ETF purchases Bitcoin to back its shares, that Bitcoin is placed in a regulated custody vault. It becomes part of a structured financial product. It is, for all intents and purposes, removed from the market indefinitely.
So an investor buying an ETF share is not buying easily accessible Bitcoin.
No, they're buying a regulated security that happens to be backed by it. The underlying asset is locked away.
So the mechanism of institutional absorption is creating what is almost like non-fungible supply. It's supply that, once it's removed, is highly unlikely to ever re-enter the immediate trading circulation unless the whole fund liquidates.
Which is extremely unlikely. And the sustained exit trend where we're seeing ETFs consistently absorbing more Bitcoin daily than miners are even producing, that is the relentless motor driving the supply vacuum. The fundamental reality is that the available supply is diminishing every single day. The price stays consolidated. It guarantees the market structure is continually tightened toward a critical point.
So if the exchanges are critically empty and the price floor is somehow holding steady around $90,000, we have to understand who has the conviction to buy and hold at this level. To really understand this resilience, we have to look at the hands holding the coin.
The long-term holders and the short-term holders.
Exactly. The LTHs and the STHs.
And analyzing these two groups is absolutely essential. It tells us whether this supply vacuum is being fueled by stable, patient hands, or if it's being driven by speculators who are, likely to panic sell at the first sign of any volatility.
Okay, so let's start with the LTHs. They're often referred to as the smart money. These are the investors who hold their Bitcoin for more than 155 days. And historically, they accumulate aggressively during bear markets or consolidations, and then they distribute slowly during those manic rallies.
Right.
So what is their behavior telling us right now, especially after that $126,000 peak?
Their behavior is, it's textbook bullish. The LTHs did exactly what they were supposed to do. They distributed a substantial amount of coins during that massive 2025 rally, taking really healthy profits.
They should.
As they should. However, the analysis shows that as soon as the price corrected and consolidated, they officially flipped back to net accumulation. This pivot, this is one of the most constructive long-term signals we could possibly ask for.
And we have specific data on the scale of this pivot, right? The recent data shows a positive shift of exactly what? Plus 10,700 BTC over the last 30 days.
10,700 BTC. And that figure represents substantial capital conviction. These are people stepping in to buy the dip.
Hmm.
Think of this as the long-term supply floor being actively reinforced. If you look at the LTH supply change chart, you can actually see these prominent, positive green bars all throughout December and continuing into early January.
Right.
This visual pattern confirms that while the price action was sideways or even correcting, these LTHs were systematically buying and removing that supply from the liquid market. They are directly responsible for maintaining that high price floor, holding strong at those $85,000 to $88,000 support levels.
I have to inject a little skepticism here, though.
Yeah.
If LTHs are just selling high and buying low, why should the market trust them entirely? I mean, couldn't they get caught out if the price drops further? Couldn't we see them start selling again?
That's an excellent question, and that's actually where the second behavioral metric comes in. The LTH spend output profit ratio, or SOPR.
Okay.
So this metric, it tracks whether these long-term holders are spending their coins at a profit or at a loss. And right now, the LTH SOPR has normalized.
What does that normalization imply for their conviction level?
It implies that they are no longer selling for profit at the current 85 to 88K support levels. They took their profits higher up the curve. The current price level is no longer perceived by them as a distribution point, but as an accumulation zone.
Ah, well,
And historically, when the LTH SOPR normalizes after a period of distribution, it signals that the large directional selling pressure from the conviction holders has ended. They're signaling to the rest of the market that, based on their long-term time horizon, this current range is just. It's too cheap to sell. They're holding the line,
so they're providing the fundamental support against the other side of the equation.
the short-term holders.
The STHs, let's look at them now. The newer participants, the ones who bought in the last 155 days, they represent the speculative froth in the system, often driven by higher leverage. If the LTHs are accumulating, then the STHs must be the ones selling.
They absolutely are. And the removal of the speculative froth is a necessary and often painful process that has to happen before the next major expansion. And the most compelling evidence of speculators exiting is just the reduction in leverage across the board. Futures open interest, which is the measure of all open speculative bets in the derivatives market, it's declined by a sharp 40% since the October 2025 peak.
40% deleveraging. That is a brutal cleansing event. What does that actually mean for the structure of the market?
It means the system has shed a massive amount of excess risk. I mean, imagine the market is a forest. High leverage is like dry kindling, right? It's ready to catch fire at the slightest price drop, which leads to cascading liquidations and panic. A 40% reduction means that kindling has been removed. The market is now far less susceptible to flash crashes or sudden massive downturns that are triggered by the liquidation of highly leveraged traders. The path for a sustained upward mood is just much, much cleaner now.
And we can see the kind of emotional evidence of this capitulation among STHs in the on-chain metrics too, right?
Yes, specifically the STCH supply change chart. If you look at the recent red bars that appear consistently in late December, that pattern signals capitulation. The short-term speculators, the weak hands, who bought close to the $126,000 top, they likely endured the correction and then finally sold their positions at the bottom of that phase. They exited at a loss or near break-even, moving their coins directly into the strong hands of the LTHs we just talked about.
That sounds incredibly painful for those who sold, but you said structurally it's vital for market health. Why is this washout, this cleansing, so critical before the next bull leg?
It's necessary because the weak hands lack the conviction to hold through any real volatility. If they held their coins, they would just become resistance later on, selling immediately once they got back to break even.
Right, the relief selling we talked about.
Exactly. By forcing them to capitulate now, their coins are moved into the highly illiquid LTH supply, which is not coming back to the market anytime soon. Historically, this type of washout, where supply moves from anxious, short-term hands to high-conviction, long-term hands, is a textbook signal that structurally, the market is ready to launch the next leg of the cycle.
So we're seeing maximum structural health coinciding with minimum liquid supply.
That's the perfect way to put it.
So we've established the long-term conviction is exceptionally solid. It's driven by LTH accumulation and a critical scarcity that's guaranteeing illiquidity. But if the floor is so high, why hasn't the ceiling lifted? Why are we still stuck in this 88,000 to 90,500 range? We have to look at the immediate friction, that crucial short-term resistance barrier that's right above us.
This is the operational hurdle. This is what separates the current consolidation from the next macro expansion. And the answer lies in the short-term holder realized price, or the STHRP. For the next few weeks, this is arguably the single most important metric for immediate price action.
Let's dedicate a little time to defining the STHRP because it's such a powerful indicator of market psychology.
Right. The STHRP, it tracks the average on-chain cost basis of all Bitcoin that has moved in the last 135 days. So essentially, it averages the price paid by every new entrant or trader during the preceding 5 months.
So it's the collective break-even point.
Exactly. The collective break-even for the majority of participants who are currently experiencing all this volatility. And the sources pinpoint this critical hurdle value right now at a very specific, very stubborn figure,
Right.
$99,000.
99,000. So the current spot price is 90,500, but the average cost basis for all these recent buyers is 99,000. That gap, I mean, that represents a massive psychological and technical pressure point.
It is substantial overhead resistance, and we really need to understand the psychology behind it. Since the current spot price is trading nearly 10% below the STHRP, these recent market entrants, the STHS, are, on average, holding their positions at a loss.
We're underwater.
They're underwater, they feel anxious, frustrated, and exposed.
This is a classic scenario. It's often called the bag holder's relief. The price drops, they panic, they worry it's going to drop further, but they hold on just in case. So what's their primary goal once the price finally moves back up?
Their primary overwhelming impulse is to get out at zero. They don't care about the next rally to a new all-time high. They care about eliminating their realized loss. That's why, as the price approaches that $99,000 level, these recent anxious buyers, they seize the opportunity to exit at or near their break-even point. They are selling not for profit, but for relief. And this supply hits the market exactly at 99,000, creating a massive concentrated zone of selling pressure.
So the illiquid nature of the entire supply is bullish, but this $99,000 wall, it represents the last concentration of remaining liquid anxiety. How big is this wall?
It's significant, because that $126,000 peak caused a lot of volume to enter the market between 99K and the top. And all of that volume is now sitting in loss.
Right.
You can see this visually in the charts. The Bitcoin price, around 90,500, has been persistently tracking below the STH realized price at 99,000 for this entire recent period. The price has been pushing up against the ceiling and just getting rejected over and over.
The operational goal for the market to progress is therefore really clearly defined. We have to turn the psychological and technical resistance into underlying support.
Absolutely. Flipping that $99,000 level from overhead resistance to underlying support is essential. Technically, it absorbs the very last concentrated pocket of that weak-handed supply. Psychologically, it alleviates the anxiety among recent buyers. And once those people are out, the path to the major psychological barrier of $100,000 becomes almost trivial.
That brings perfect context to the short-term grind. But let's zoom out now. If short-term holders are this anxious, and the price is fighting for its life at 90,000, what do the macro on-chain valuation models tell us? The ones that analyze where we are in the total cycle relative to history. Are we still early in this expansion, or was that $126,000 top a sign of mid-cycle weakness?
The macro model suggests we are definitively early to mid-cycle, and critically, we are far from euphoria. We can illustrate this using two primary metrics that measure the market's fundamental value versus its current price.
Okay, let's start with the MVRV score. This compares the market cap to the realized cap. Can you explain what realized value truly represents and why this metric is considered sort of the gold standard for spotting cycle extremes?
Right. Realized value is, I would argue, the most powerful metric for measuring the true aggregated cost basis of the network. Instead of just using the current market price, it takes the price of every single Bitcoin the last time it moved on the blockchain.
Oh, interesting.
This gives us the total stored or invested value in the network. The MVRV Z-score then compares the market cap to this realized cap, and it calculates how far the current price is deviating from that fundamental investment cost.
So what's the current Z-score, and how does that stack up historically?
The current Z-score is incredibly low for this stage of expansion. It's at 1.15.
1.15.
This is the key insight from our analysis. If you look at historical cycles, every major cycle, top 2013, 2017, 2021, occurred when the Z-score was typically above 7.0.
Above 7 versus our current 1.15. That is a chasm. Does this suggest that the $126,000 peak back in October was merely a mid-cycle consolidation peak?
Precisely. The analysis confirms that signal. The low score of 1.15 indicates that Bitcoin's market value is not significantly stretched above its realized or stored value. If the z-score were above 7, it would mean that virtually every holder is sitting on massive profit and the probability of a major correction is extremely high.
Right.
At 1.15, we are still far closer to the historical average cost basis than we are to the parabolic extremes that signal fundamental overvaluation.
Yeah.
We have massive room for expansion before we enter historical danger territory.
But I want to challenge this model slightly.
Yeah.
Is it possible that institutional adoption changes the dynamic? I mean, maybe the z-score needs to run less hot now because the market is more mature, less retail-driven?
That's a valid consideration. But even with maturation, the underlying principle of market value versus stored value still holds. A move from 1.15 to, say, 4.0 or 5.0 still represents a massive multi-factor price appreciation from where we are now. So while the absolute peak might not hit 7.0 in a more mature cycle, the current level still screams undervalued relative to cycle potential. It proves the current consolidation is not a sign the cycle is over, but that energy is being built on a very stable foundation.
Okay, let's move to a metric that captures the psychological mood more acutely, the net unrealized profit loss, or NUPL.
Right, NUPL. This measures the overall market sentiment based on how much profit or loss is floating across the entire network.
Yeah.
And the NUPL value right now is hovering around 38%.
38%.
Yeah.
And the charts we're looking at categorize sentiment based on that percentage. Where does that put us?
It places the market sentiment firmly in the optimism anxiety zone.
That is a perfect emotional descriptor for the market right now. Optimistic about the future, but anxious about the short-term resistance. What defines this specific zone psychologically?
This zone is characterized by internal conflict. We saw the euphoric phase leading up to 126K, where people were booking huge profits. Now, the fear is twofold: anxiety that the price will drop back down, and optimism that the breakout is imminent. This anxiety is what drives the behavior we discussed earlier, the urge for STHs to take break-even relief.
And how does this 38% level contrast with historical peaks?
Well, historical cycle peaks, the phases where distribution is rampant and risk is highest, they occur deep into the euphoria zone, typically registering above 75%.
75%.
The fact that we are only at 38% confirms that the market is showing profound caution and patience. The sentiment is far from manic. We are not seeing the behavioral signs of an overheated near-top market.
Okay, beyond valuation and sentiment, let's do a quick technical health check on the network itself. Let's look at indicators like the RSI and the state of the miners, who are, the operational backbone of the whole system.
Starting with the Relative Strength Index, the 12-month RSI. This tracks the speed and change of price movements. It's currently sitting at a very neutral 52.83.
And why is 52.83 significant in terms of momentum?
Well, an RSI reading close to 50 is a sign of sustainable equilibrium. Readings above 70 are typically considered overbought and signal a need for correction. Our current reading indicates slowly building momentum, but crucially, it's not exhibiting that manic vertical buying behavior that signals an imminent top. It's a neutral, stable signal.
Finally, let's discuss the mining environment. We noted stability in the hash rate moving averages, meaning the network is secure. But you highlighted a critical tension here.
Yes, the price context matters immensely. Miners are operating in a highly competitive, high-difficulty environment. Securing the network requires huge operational expense. But while difficulty is high, the price action is suppressed, trading well below that October peak.
That sounds like a significant squeeze on their profit margins.
It is. Miners constantly have to cover costs. And when the price is suppressed while difficulty is high, their margins are compressed significantly. This forces them to be very careful about selling.
So a constrained miner selling force feeds directly back into the supply vacuum thesis.
Exactly. This tension implies that miners, because they're feeling the squeeze, will be increasingly constrained in how much they sell. They'll hold on to wait for a better price. And the structural compression adds another layer of long-term bullish pressure. Reduced miner selling, combined with institutional absorption, just deepens the illiquidity crisis.
We've covered the structure, the psychology, the fundamentals. Let's pull all these threads together now. We have acute illiquidity, characterized by that record low 2.49 million BTC exchange balance. We have healthy macro metrics, like the MVRVZ score of 1.15, The system is screaming, as one report put it, a gathering of energy.
Hmm.
So what does all this accumulated energy mean for the 2026 future outlook?
It means the supply shock is no longer a theoretical risk. It is the unavoidable narrative for 2026. Based on current absorption rates, especially the fact that institutional ETFs are absorbing more Bitcoin daily than miners are producing, the breakout is a mathematical certainty. The market is becoming so starved of liquid supply that eventually buyers will simply run out of accessible coins to buy.
Let's break down the projected timeline, starting with the immediate future, Q1 and Q2 of 2026. The report calls it the grind.
Yes, the grind. The projection is for Bitcoin to remain in this challenging sideways consolidation or chop for the immediate term. This period is necessary for continued LTH accumulation and, crucially, for absorbing that $99,000 STHRP resistance. The main objective during this phase is to finally reclaim and solidify the $100,000 psychological barrier.
So how does that grind play out against the 99K wall?
It'll happen incrementally. Exchange reserves will continue to thin out, making each wave of demand more effective. As buyers repeatedly test that 99,000 level, they absorb the last pockets of selling anxiety. And once 99K is flipped from resistance to support, the momentum shifts entirely.
And what happens once we move past the grind into the second half of the year, H2, the expansion?
This is where macro conditions become the crucial catalyst for acceleration. The analysis highlights that while the supply side is fixed, the demand side can be radically increased by external factors. And the primary external driver cited is the potential for macro liquidity improvement, specifically through decisive Federal Reserve rate cuts.
So if capital becomes cheaper and more abundant, it flows into risk assets, and it hits this critically starved Bitcoin supply.
Exactly. When institutional capital that's been waiting on the sidelines hits a market where less than 13% of the supply is liquid, the reaction will be exponential, not linear. This is where the mathematical inevitability of the supply shock proves itself.
And what do the moderate consensus price targets look like under that scenario?
If that macro catalyst arrives and the market structure holds firm, which all the on-chain metrics suggest it will, the supply-driven rally could push Bitcoin toward the $135,000 to $175,000 range during the second half of 2026.
Okay, that's the base case, but there's also the aggressive bull case.
Right, which requires an even bigger inflow. The aggressive scenario relies on a more dramatic, game-changing catalyst. Aggressive institutional adoption on a scale we just haven't witnessed yet.
What does that look like?
We're talking about flows far exceeding the initial ETF enthusiasm. Think large-scale investment from global players, major corporate reserve shifts, or maybe most impactfully, the long-speculated entry of sovereign wealth funds.
That type of seismic inflow hitting an environment where the available trading supply has been suffocated down to 2.49 million BTC.
Yeah.
That would be truly explosive.
Absolutely. In that aggressive scenario, the combined force of momentum and critical illiquidity would translate into rapid price discovery. Analysts suggest that this could combine to push price targets to levels that exceed $200,000 within 2026.
This has been a tremendously insightful deep dive. Let's synthesize the key takeaways for you, the listener. The market structure is highly constructive. It's defined by a critical, multi-year scarcity, just 2.49 million BTC on exchanges. And this scarcity is being actively manufactured by the conviction of the smart money, the long-term holders.
And crucially, we know the exact metric defining the path to expansion. Immediate progress hinges entirely on the market's ability to decisively clear and hold that $99,000 break-even resistance. That will alleviate the final pockets of short-term holder anxiety and complete the necessary market cleansing.
So this current consolidation we're in, it's not a sign of fundamental weakness or cycle exhaustion.
No, it's the final necessary groundwork. It is a gathering of energy, a compression phase required to flesh out the remaining weak hands before the underlying structural supply dynamics, that overwhelming supply vacuum force, the inevitable next macro expansion.
Which leaves us with a pretty profound and provocative thought for you to mull over. Given that the MVRV Z-score is sitting so far from historical cycle highs, just 1.15, when previous tops were above 7.0, and we've confirmed that the liquid supply has evaporated to the tightest level since 2018, how much longer can that purely psychological short-term resistance at $99,000 possibly hold against the overwhelming fundamental illiquidity and the looming potential of exponential institutional inflow?